So guys, it finally happened. The most anticipated rate cuts that we've ever known in recent memory. The Fed is trying to thread the needle very carefully, and that's why the market remains very watchful. When the Feds cut short-term rates, or when the long-term treasury yields come down, it becomes cheaper for companies to borrow money, right? When the money market fund rate lowers and not remain as attractive to those people who had put their money in there, and remember $7 trillion is there, guess where that's going to go? So these are technology, consumer discretionary, REITs, home builders, and utilities. And let me explain why. So as you know, tech is often the biggest beneficiary of falling interest rates. And the reason is because tech companies are growth oriented. And ever since the year to date, the S&P 500 has already returned 12.51%. And since the April lows all the way from here to here, the S&P 500 is already up approximately 37%. Year to date, since the beginning, the Nasdaq is up 16.22%. Again, as of a few minutes before the start of this webinar. And since the April low, the Nasdaq is already up almost 48%. Welcome everybody. Today is September 18th. In today's session, we're going to discuss all about what's going on in the market and more importantly, where it might be going, especially in light of the recent interest rate cut and what kind of future rate moves are being priced in at this time and how all this is going to impact the stock market and the valuations. I'm going to walk you through how the rate cuts flows through the market, which sectors are likely to benefit the most. And we're also going to look at some historical and current data to get a sense of what could happen next in the broader indexes. And as always, this is not about predictions. It's about helping you understand the macro context so you can think clearly while staying grounded and make informed long-term investing decisions. So with that said, let's dive in. So guys, it finally happened. The most anticipated rate cuts that we've ever known in recent memory. Yesterday, the Feds finally announced in the United States a 25 basis point cut, bringing the overnight lending rate from 4.25% and 4.5% down to 4.0 to 4.25%. So that was a 25 basis point cut that happened yesterday. Now, obviously, this did not surprise anybody, right? The markets had priced this in for weeks. But what's more important than the rate cut itself is why did the rate cuts actually happen? Now, if you look back, inflation, as you know, had been cooling very consistently. But over the last few months, what started happening was that the inflation started to creep right back up. And when inflation started to creep right back up, that's where the Feds came back and like, hey, we need to do something about this. So inflation we know has been increasing just over the last couple months. But why has that been increasing? Well, it's actually been increasing because of job market. So the job market has been kind of weakened over the last little while. It's so interesting that the May and June payroll figures were actually revised by 250,000, which is 250,000 jobs. Now, this puts Feds in a tough spot. And even the Fed chair, Jerome Powell, said directly that, right now where we're sitting is we have two-sided risk. What they're trying to do is they're trying to strike a balance between controlling inflation and at the same time supporting employment. If they cut the interest rates too slowly, then the economy could slip into a recession. And if they cut their interest rates way too quickly, then what's going to happen is inflation is going to come back roaring. So the move that the Feds have now taken, it was essentially a precaution that the Feds took to keep the job market from deteriorating further and also making sure that inflation doesn't run up way too much. Now, what I have on here is the Fed's interest rate. So if you notice that up until, in 2022, they raised the interest rates really, really rapidly. And then they kept it flat. They wanted to see how the market was going to behave. And interestingly, the stock market kept doing really well. But what recently came up was that the job market was starting to struggle. But the inflation was starting to come down. So this is one of the reasons why later 2023, all of 2024, or most of 2024, and even most of 2025, the interest rates were not necessarily touched overly too much. They did bring them down a bit, but then they again kept them stable. Right now, they have brought it down to, they've cut 25 basis points. But if you look on the right side, and this is also a chart that I have shown you already, we are, right, 2025, we are here somewhere, or here, 4.0%. to 4.25%. So somewhere here. What the Feds want to do is this year, the expectation is that the interest rates will come down to somewhere here, 3.75, 3.76%. So that means there's going to be an expectation. The market is already pricing in an expectation of 2 more rate cuts. So if those rate cuts happen, the interest rate by the overnight lending interest rate is going to sit somewhere here at 3.76%. And then later next year, there is still an expectation of a rate cut, and towards the end of 2026, it's expected the market will be sitting at 2.9% from where it currently is at. But then after that, it's expected that the Feds may start increasing interest rates. Again, these are all expectations, right? So Feds may start increasing interest rates because there's an expectation that the inflation is going to increase. So we are in a rate cutting phase for now, but this isn't just a one-way path. The Fed is trying to thread the needle very carefully, and that's why the market remains very watchful. Remember, the Fed's job is to manage the economy. They don't want to let the inflation go too high. They also don't want to get it too slow, so it completely slows down the markets, right? So this is a balancing act that the Feds keep playing. Now, yesterday, as soon as the Feds announced a rate cut, an immediate impact showed up in what? The short-term interest rate. So here is the short-term US bond yield. I actually just took a screenshot 10 minutes before. So what happened immediately after was that the yield did go down, but today it's starting to pick back up. But what's interesting to note is that ever since August, look at this, ever since August, when the probability of the Feds cutting interest rates started to increase, notice the yield already started to come down. And it came down a lot. So it started at around 4.2%. And by 10 minutes ago, the 1-year yield was sitting at 3.693%. Now, why does this matter to us? This matters because the short-term instruments like the 1-year treasury, they're directly related to Fed's policies. Now, when the yields fall, the returns you're getting on those instruments, especially like in your brokerage sweep accounts or the treasury bill, they also start to decline. Now, which brings us to the next natural question, which is how does the long-term bond yield behave? Because it's that long-term bond yield that also tells us a very different story about the market's expectations around inflation, its growth, and the overall risk. Because again, the Feds control the short term, but the Feds do not control the long term. So not the long term. So let's have a look at how that behaved. So here is a side-by-side comparison of what's happening in the bond market. The candlestick chart gives you the 1-year or the short-term treasury yield. And the solid green line that I have, that shows us the longer-term treasury yield. And here I have the 10-year yield. So what's interesting is that while the short-term yield started falling as early as August, that did not translate the same way in the long term. So notice the green line. The long term has been very consistent. So in August, when the short term fell, the long-term bond did not fall as much, although it did start to go down, but it didn't go down as much as a short term. And also what happened is, so here, look, notice it stayed consistent. It's only in September that it actually fell, but even here, it's starting to stay consistent. Now, here's what's interesting. The short-term yield, as I mentioned, are set by the market, which is, and who is in the market? These are institutional investors, pension funds, banks, and even retail investors like you and me. It is people like us or people like, these investors who do buying and selling of long-term bonds that affect the long-term bond yields. Now, why are we interested in thinking about the long-term bond yields? The reason is that the long-term bond yields affect the mortgage rates, and the impact on the long-term bond yield is when investors become interested in purchasing them when they think the long-term inflation is going to get curbed. Because the understanding is that the stock market delivers better returns than the bonds. So when will people become interested in long-term bonds? When they think that the bonds are producing better returns than the stock market. And because stock market is expected to produce better returns than the inflation, so if the inflation starts to go down, the understanding in the retailer's mind is that the stock market is not going to produce that better returns. So instead, at that time, when the inflation expectation is that it'll go down in the future, that's when people's interest increases in bonds and the bond prices goes up. And when the bond prices go up, because they're inversely related to the yield goes down. So at this time, while the yield has gone down, it actually hasn't gone down much because there is still an expectation that maybe in the long run, it'll take some time for the inflation to get curbed. Now, that brings us to what is happening with the recent Fed's rate cuts. So as you know, while it directly impacts the short-term rates, it can still serve as a signal to investors, almost like giving them a nudge that the Feds, what they're doing may actually start to impact the long-term bond yields. Now, when that happens, it is giving a view to the investors that, you know what, when the inflation goes down, maybe start looking at the long-term bonds. Now let's shift our focus and see how the stock market is actually taking that message, both from an actual rate cut point of view and the idea that the long-term inflation expectations might start to stabilize. Let's talk about why falling interest rates, both short-term and long-term, can have a direct impact on stock valuations. So you see, when the Feds cut short-term rates, or when the long-term treasury yields come down, it becomes cheaper for companies to borrow money, right? When the Feds cut rates, some interest rates are going down. So because it makes it cheaper for companies to borrow money, which could be through taking on loans or by issuing corporate bonds at a lower interest rates, which is a way in which a company can raise money, because the cost of capital starts to go down, that reduces the average cost a business pays to raise money, whether through debt or equity. And as that goes down in our valuation model, let's say the CAPM, the capital asset pricing model, that is directly related to the discount rate. When the cost of capital goes down, it reduces the discount rate. And when the discount rate goes down, the valuation goes up. So in the short term, companies that are dependent on raising money from bank loans or whatnot, as their cost of capital goes down, that increases their valuation. And in the long run, when retail investors think that the inflation is going to go down, that reduces the long-term borrowing cost, which also positively impacts the stock market and the valuations go up. There was a chart that I had showed in my last presentation. I'm going to bring that up again because now it's important to see that what we were earlier planning is actually now happening. So here's what's happening. Overnight lending rate right here has now just been lowered, and there's an expectation that 2 more rate cuts will happen this year. So that means the overnight lending rate is going to keep going down. Now, overnight lending rate is connected to 2 things: short-term loans and lines of credit and money market funds. So as the overnight lending rate goes down, guess what? The short-term loans and line of credits also goes down, right? That's a rate they're going to charge, so that's going to go down too. When that goes down, guess what? The money that is required by small and mid-cap companies to run their operations and to do whatever they need to do to hire more people, essentially that money becomes available that much more. Liquidity grows and the cost of doing business for these companies goes down. Consequently, what happens is they will take on that debt to run their operations and ultimately hire people. This is what the Fed is currently trying to do. This is the reason they have lowered the interest rates. Now, as the overnight lending rate goes down, we know that the interest rate that is being provided in the money market funds, that also lowers. And there was a chart I had shown you earlier that there are approximately $7 trillion currently sitting in the money market funds. Where does that go? When the money market fund rate lowers and the money market fund does not remain as attractive to those people who had put their money in there, and remember $7 trillion is there, guess where that's going to go? Well, that's going to go into potentially into the stock market. And have you noticed that the stock market has been picking up? Well, here's one reason. Other is that once the investors realize or believe that the long-term inflation is also going to get curbed, well, guess what? This money is going to move into the long-term bonds, and the long-term bonds interest goes up, and therefore the bond prices go up. And as the bond prices go up, because the long-term bond prices are also inversely related to the bond yield, guess what? The bond yield goes down. And as the bond yield goes down, the mortgage prices go down. And as the mortgage prices goes down, because this is directly related to the risk premium, and that risk premium affects the discount rate, and that discount rate is connected to the stock valuations, and therefore the stock valuations go up. So this is the overall relationship, again, that I wanted to bring to your attention. We covered this last time where we're anticipating that when this happens, what could occur. Now that this has happened, which is the overnight lending rate has gone down, that these are the impacts that are going to happen in the market. And you're already seeing those take place in the market. Now, let's start off with sectors that tend to do well when the rates come down and those that may not do as well. So let's start with the ones that actually do well. So these are technology, consumer discretionary, REITs, home builders, and utilities. And let me explain why. So, as you know, tech is often the biggest beneficiary of falling interest rates. And the reason is because tech companies are growth oriented. Their value comes from earnings that they're expected to generate far into the future. And when the interest rates fall, well, we discount the future earnings at a lower rate. And that makes those future cash flows worth more today, and the valuations rise. That's why we often see that the tech sectors tend to rally when the rate cuts are announced or if they are expected. The second is consumer discretionary. Now, these include companies that sell non essential goods and services. So think of like travel, retail, luxury brands, and restaurants. So when the rates drop, obviously the liquidity of the money goes up and the borrowing becomes cheaper. And then what happens is consumers at that point become more willing to finance big ticket purchases like cars and vacations and home improvements. And that boosts demands, which supports company revenues and the stock prices in that sector. The next sector that gets affected is the REIT sector or the real estate. So, as you know, real estate is highly sensitive to interest rates. Lower rates reduce mortgage costs, which drives up demands for homes and the commercial properties. And for REITs, which is real estate investment trust, which often carry debt, lower interest rate tends to reduce the cost of borrowing for them. And because REITs also pay out dividends, their yields become more attractive relative to safer assets like bonds, especially when the treasury yields are falling. So the money that $7 trillion is talking about, well, it has a potential of also going into REITs or real estate. Next is directly connected to REITs or real estate is the world of home builders, right? This is very closely tied to real estate, but I want to talk about it in a separate way. Remember, lower rates mean lower mortgage payments, which tends to drive up home buying activity. Now, that benefits not just builders, but also related sectors such as construction, home improvement, and materials. Utilities, which seem boring, but in a falling rate environment, they can tend to benefit. Now, these companies often carry large amount of debts, so lower interest rates reduce the financial costs. And because utility companies typically pay stable dividends, those dividends look more attractive when the bond yields drop. Now, I personally don't invest in utilities, but for anybody else who's interested or who cares about that, this is what happens in the background. Again, nothing that I say today is me telling you that you go buy and sell. I'm just sharing all this so you can make more informed decisions. Now, here are some sectors with mixed and limited impact. So, number one is financials, but financials could be a little tricky. Why? On one hand, you have lower interest rates, right? Lower interest rates compress the net interest margins, and which is basically the difference between what banks earn on loans and what they pay on deposits. This can lower the profitability of the banks. But on the other hand, lower interest rates also lend to more borrowing activity and more lending activity, which helps offset that margin pressure. Essentially, from a lending and loans point of view, their profits go up. So this ends up balancing them. Or it can potentially help it improve as well, but that's where it remains. Next is energy. Energy stocks like oil and gas. Well, these tend to be driven more from commodity prices rather than interest rates. That said, falling interest rates can weaken the US dollar. And when the US dollar gets weakened, that supports higher oil prices. But again, it's an indirect effect, not a direct rate sensitivity. And lastly, healthcare. Now, this is a funny sector because recently healthcare was not doing as well, but a lot of money is being rotated there. However, typically healthcare is a defensive sector, which means it's less cyclical and less sensitive to rates. People, still need medical care. They still need to go to hospitals, drugs. They still need to purchase insurance, whether rates are high or low. But healthcare can benefit from a flight to safety during uncertain times, especially when investors want more stable and more predictable earnings. So the final takeaway here is that rate cuts tend to favor growth sectors and those that benefit from consumer spending and cheap financing like tech, discretionary and real estate. On the other hand, defensive or commodity linked sectors like healthcare, energy, they're less rate driven, so they're less impacted by rate cuts. Now, I've also taken this screenshot of the S&P 500 just about 10 minutes prior to starting this webinar. So notice how the market has done. So as of today, the index had actually performed really, really well, and it's still making an all-time high. And ever since the year to date, the S&P 500 has already returned 12.51%. And since the April lows all the way from here to here, the S&P 500 is already up approximately 37%. And just since the month of August, the S&P is up almost 3%. Because I already mentioned that investors were already pricing in that there is going to be a reduction in rates. And I've also told that reduction in rates tends to impact valuations. So when valuations goes up, the stock market goes up. And something very similar has happened with Nasdaq as well. In fact, Nasdaq has done even better than the S&P 500, but that's expected because these are growth stocks and they are in the tech sector. So check this out. Year to date, since the beginning, the Nasdaq is up 16.22%. Again, as of a few minutes before the start of this webinar. And since the April low, the Nasdaq is already up almost 48%. And since the end of August, the Nasdaq has also gained almost 4.5%, which is also really, really good. Again, those are all in anticipation that the Feds were cutting interest rates. But we know that the Fed's interest rates have been cut right now at an all-time high. Now, a lot of people must be wondering, well, Amit, this is all-time high. Is the market going to collapse because, everything's looking really, really good? So I have a chart here that's been produced by Carson Research, and it shows all the times in the past when the Feds cut interest rates near all-time high. And what did bulls do? The bulls actually loved it. So this is S&P 500 returns after Feds cut within 2% of an all-time high. Now, whether the all-time high is going to carry on after, we don't know. But certainly when the Feds cut rates yesterday, a day before, the market was at an all-time high. So what happened? Clearly, check this out. This has not happened in isolation. This has been happening. We have actually records of this happening from a long time. So since 1980, 83, 85, so on and so forth, all the way to 2024. So when the Feds cut interest rates, when the stock market was at an all-time high within 2%, what happened in the next month? Well, the next month, for 50% of the time, so flip the coin. For 50% of the time, market went up. Another 50% of the time, market went down in the month following. And how much was the return that the market gave? 0.4% was the average return. 3 months thereafter, 77% of the time, the market gave positive returns. And by how much? 3.3%. 6 months thereafter, the market was up 72.7% of the time. And the median returns were 3.4%. And by the way, my apologies, in the previous one, the average returns were 2.3. The 3.3 is a median return. And 1 year after that, check this out, 100% of the time, the market went up. How is that going to behave this time? Again, we don't really know, but historically, it has gone up by 100% of the time, and the average return has been 13.9%. So I'm showing this to you guys that yes, the cuts have happened at an all-time high. These have happened in the past. Don't think of this as an isolated event, that something very new has been happening this time. Again, past performance is not a correlation to future performance, but this is what's happened in the past. Now, 2 weeks ago, I shared a research to you guys showing that the September is historically the worst performing month of the year. And at that time, I asked the obvious question. I asked, is that going to happen again this year? And then my answer was, we don't really know. I also pointed out that there's another historical trend that if the August rally is really good, September typically shows up as a not so good month. And so naturally at that time, I also asked, is that going to happen this year? And again, my response was, well, we don't really know. So that was when we were at the start of September and we didn't really know how the month was going to play out. Now we are in September. We know what's been happening, at least up until now. And September right now is defying the usual seasonal weaknesses. Now, of course, no one can really say for sure because September is not done yet, but we can think why did the market go up is because it was pricing in the optimism. And it's clear that the optimism is still driving investor behavior. And if you've been following me in my previous webinars, you'll recognize that the tailwinds that I had discussed earlier are still very much intact. Let me walk you quickly through those four major tailwinds that I spoke about in the past and how they're still affecting and impacting the stock market. So what are these tailwinds? The first is the rate cuts. We know that the rate cuts were being anticipated, and now Feds have officially cut the rates by 25 basis points just yesterday. And this is something the markets were anticipating for weeks. That move alone signaled that the tightening cycle the Feds were doing, where they were increasing the interest rates, maybe that's behind us. But even more important, markets are now pricing in more rate cuts. So lower rates means cheaper borrowing costs, and that lowers the cost of capital, which directly supports the higher stock valuations. Now, something obviously that we've already discussed in the past. The second tailwind is earning strength. So corporate earnings, especially in technology and healthcare, continue to outperform expectations. And as I have always emphasized before, profits drive stock markets performance. As long as the earnings hold up, they give markets a strong reason to keep going higher, even in months that are historically weak. The third tailwind is liquidity on the sidelines, right? So there is still a huge amount of cash that is parked in money market funds. And I've already shared a figure past in the previous webinars, and that's approximately $7 trillion. Now, with rate cuts now in place, the short-term yields will likely drift lower. And that opens the door for some of that capital, that $7 trillion that's sitting in the sidelines, to be rotated back into equities. And the market is already anticipating that shift. And the next is softer dollar. So the US dollar has eased slightly in the recent weeks, and that's bullish for the US multinational because it improves the overall earnings when they're converted back to US dollars. Remember, multinationals are also operating in other countries. So when the US dollar goes down, they can sell more. And then when they convert that back to US dollars, then obviously the revenue increases. So when the revenue gets lifted, then the valuations get lifted. And that's one of the other reasons, which is acting as a tailwind for multinational firms and ultimately the large cap companies to go up. So when you combine the confirmed rate cuts, the strong earnings, the liquidity that could actually flow into the market, and a weaker dollar, it becomes easier to understand why September is breaking this pattern this year. But with that said, folks, I just want you to I want to bring this to your attention that September is not done yet, right? It's still the 18th. We still have a couple weeks left. And markets can turn very quickly. But so far, the message is clear that the fundamentals and optimism are performing well, and that's impacting the seasonality. But we're going to wait and watch what actually happens because seasonality still plays a role for various reasons. Now, in our Telegram community, there are also people who've been asking me that, hey, Amit, the market is so high. There may be a crash coming. We're at an all-time high. Is this bull market even sustainable? Now, of course, as you know, no one really has a crystal ball, but we can build some perspective. So for example, here's another research that shows the different bull markets from the past. How long did they last? What were their returns? And where are we in comparison to that? So thanks to Carson Research, again, beautiful research this company has done. So let me show you. These curves represent the bull markets of different years and how long they lasted. So for example, let's look at this one, this black one. This is the 2000, from 1987 to the year 2000 bull market. It lasted for 12.3 years. The second bull market, have a look, is this blue one. And this blue one lasted from 2009 to 2020 and produced almost 400% return. The previous one, which lasted until 2000, that produced somewhere close to 600% return. And then we have this gray line. This lasted from in August 87, lasted for 5 years and gave slightly over 200% return. Then you have something here, October 2007 one, which is a gray line. That gave almost 100% return. And this red line represents a current bull market. Now, this is where it gives you a perspective. Check out the other ones and check out the today's bull market. So we are almost 3 years old. Almost. So we're almost 3 years old. And we have not even given 100% return yet, or this bull market hasn't even given that. Now, again, I don't know how this bull market is going to produce and where it's going to go, but I am just trying to put this in perspective for those of you who are thinking that, hey, this bull market is so unique, maybe it's going to crash. Well, when you put it in perspective with previous bull markets, then suddenly it doesn't seem all that out of proportion. We are tracking in the kind of a similar way in the past, and there's a potential of a huge move. Whether it's going to happen or not, I don't know, but I wanted to put this in perspective. So what I would say at this time is we're still a relatively young bull market, which is just about to turn 3. Its older brothers and sisters have lasted a lot longer. Now, I want to inform you guys that seasonality, while September has been doing really, really well, seasonality is still there and it still comes to play. So this is a chart that I had shared some time ago. So we are somewhere here in September. So right now, yes, the market has actually gone up, but we still have the rest of September left. So there could still be a potential of market doing poorly for the rest of the month, but we'll have to wait and watch. And then comes the well-known Santa Claus rally. So typically towards the end of the year, the market tends to do well because people, I think consumers just tend to spend a lot more. So again, I wanted to bring this and put this in perspective for you guys. That brings me to the end of today's presentation. Hope this was useful. And if you guys have any questions, I'll open it up now to you.